All right, welcome back. We're going to turn to our second topic today, which is an update on our leases post-implementation review. And let me turn it over to Jen to start us off. Good morning, Jen.
Thank you, Rich, and good morning, everyone. So the purpose of today's meeting is for the board to discuss the post-implementation review, or PIR, activities that have been completed to date for Accounting Standards Update 2016-02, Leases, Topic 842. As background, the Leases Standard was issued in February of 2016 and was a result of the FASB's and the IASB's efforts to increase transparency and comparability among organizations by recognizing lease assets and lease liabilities on the balance sheet and disclosing key information about leasing arrangements. The primary change in the FASB's lease standard in IFRS 16 was the recognition of lease assets and lease liabilities by lessees for operating leases. Although lessor accounting was intended to be substantially unchanged from legacy GAAP, the board sought to align various aspects of the lessor accounting guidance with the guidance in Topic 606 and to provide incremental disclosures in how a lessor manages its exposure to residual values of the assets it leases. The Leases Standard was effective in 2019 for public business entities, not-for-profit entities that have issued or are a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or an over-the-counter market, and employee benefit plans that file or furnish financial statements with or to the SEC. We will refer to those entities as public entities. And after the board provided 2 effective date deferrals, the Leases Standard was effective for all other entities in 2022, which we will refer to as non-public entities. The expected benefits and cost of the Leases Standard are included in the board meeting handout from paragraphs 7 through 11 for lessees and paragraphs 36 and 37 for lessors. The PIR of the Leases Standard began immediately upon the issuance of Update 2016-02. Although a transition resource group for the Leases Standard was not created, primarily because many of the key concepts in the standard were similar to those in legacy GAAP, the board and staff assisted stakeholders during the implementation of the Leases Standard by proactively seeking feedback on implementation issues arising from those efforts. Stakeholder feedback led the board to issue 8 accounting standards updates for clarification or simplification in various areas and 2 accounting standards updates that deferred the effective date for non-public entities, as I already mentioned. In addition, the board provided ongoing implementation support through the FASB's Technical Inquiry Service, a FASB staff question and answer paper, interactions with stakeholders through advisory group meetings, outreach discussions with individual and group stakeholder meetings during transitional periods, surveys, conferences, and review of academic literature. So during today's meeting, I will tee up the lessee PIR activities and the related feedback received, and then I'll pause for board discussion. And then Ashley will tee up the lessor PIR activities and the related feedback received and pause for board discussion. And then Lauren will tee up the PIR activities related to investors and the feedback received, and then we'll pause again for board discussion. Now, as next steps in the PIR, a public roundtable is being held on Friday, September 12th. Participants will include investors, both private or non-public entity and public company investors, practitioners, and preparers representing both public and private entities from a variety of industries. The staff will then discuss that roundtable feedback and its observations and findings from the PIR at a board meeting shortly thereafter. Now, before I move into the details of completed lessee PIR activities, I will pause for the board to discuss questions 1 and 2, which ask, does the board have any questions or comments about the Leases Standard or its expected benefits and cost? And does the board have any questions or comments about next steps? So with that, I'll turn it over to the board.
Okay, great. Any questions? I think it's clear from Jennifer's tee up, there's multiple steps still left in this process. And while much of our discussion today is specific to the lease standard itself, part of our lessons learned will also be about future standard setting, right? And process changes we might want to consider or lessons learned. And I would just start off with thanking the staff for an awfully robust set of materials here. Although a 10-year project that had one discussion paper, 2 exposure drafts, a joint project with the IASB, 13 years before it was from adding to our agenda till it was adopted by public companies, and 16 years for private companies. A lot can happen in that time. And then add to it a government mandated SEC study on off-balance sheet financing, which is the only one that I'm aware of that we've ever gotten that kind of directed us towards a project. So lots of different things here, lots of unique things that the staff's highlighted. But it sounds like much of our day today will be focused on specifics to the lease standard as issued, and did it achieve some of the objectives that were set out and so on. With that, let me just see if there's any questions or comments from the board before we get started. Sue?
So are you focusing on questions 1 and 2 in the handout? Is that right?
Yes, correct.
Okay. So maybe on question 2, on the next steps, and certainly you did a great job of outlining the roundtable, and I'm personally looking forward to the feedback that we get from the roundtable. And I like that you have a great cross-section of stakeholders that are included in that. And I think Rich sort of alluded to it in his remarks, but I think that from a process perspective, there's a lot of things that we learned during the development of this standard, as well as some of the other large comprehensive standards that change some of the way we do things. And I know that isn't necessarily part of this package of papers that you provided, but I'm hoping that at some future meeting, we'll talk about those process improvements and perhaps some other things that we can do to improve our process. I think that one of the things that I wanted to mention is that I would just continue from a next steps perspective for the PIR team to continue to incorporate into their work and their efforts the work of the PCC as it relates to some of the research that they are performing based on recommendations from private company stakeholders and their specific leases working group. I think that you inform them, and I think that they inform you. And so I think that the issues can be particularly useful as we're thinking about the feedback that you've gotten to date. And it would seem to me that some of the issues that they potentially may be researching are not necessarily common to private companies. I think they may be feedback that we've gotten from public companies as well. So I just think that as part of the PIR work, they're part of the cog in the system. And so I think we should leverage them as well. So.
Okay, great. Christine?
I just wanted to comment on the academic research that is part of our post-implementation review. I think that it plays a very important role because for a lot of what we hear from our stakeholders, particularly from preparers and auditors, the academic research confirmed what we were hearing anecdotally through all of that outreach, and that's very comforting. I also think that because our outreach and feedback from investors is generally much more limited than what we hear from auditors and preparers, that the academic research that looks at large samples and can provide insights into whether or not the standard resulted in benefits to the capital markets is really important in helping us to understand the benefit side of the equation. And I also think that and I'll speak to this a little bit later, but there's also some evidence in the research regarding things that we don't hear. So, stakeholders don't generally say to us, yeah, we shifted to leases that were shorter in term and had more variable lease payments as a result of the standard. So I think, excuse me, in all three of those fronts, the academic research is very, very important. And I'd like to commend our past postdoc fellow, Derek Christensen, but also our current postdoc fellow for their work on that very good summary of the academic research. In terms of next steps, I do want to point out that we did have 33 studies produced by the academic community, which was really helpful. That was a lot of work done in a relatively short time in terms of academic time. And I think that we did a lot to try to support the production of that research. Even before the standard was implemented, we were meeting with academics and talking with them about some of the questions that we would have. And they really stepped up to the plate and helped a lot by focusing research on those issues that we had identified in advance. So that was super helpful. But I do think that we always need to remember that the post-implementation review timeline is short relative to the amount of time that it takes to get an academic paper through the entire process. And we can see that in that a number of the papers that we are utilizing are working papers, which means that they have not had the full benefit of the review process. We also need to recognize that behaviors around the time of implementation can be quite different than behaviors 5-10 years after a standard has been out, when the laser focus of auditors and preparers on implementing the standard has waned. And investors have gotten more used to having access to the information and have figured out how best to utilize the information. And so I think that, and I've said this before, that on these major standards, I think it would be important for the board to come back 10 or 15 years after the standard has been implemented and see if there's any additional research that has been done and if the results are consistent with what was found right around the time that the standard was originally implemented. The last thing, I did have a question for the staff, and I want to understand, how we're thinking about taking all of the feedback that we get from the post-implementation review. And clearly, there are going to be areas where some people think we should be doing some additional work, whether it be on disclosures or on recognition and measurement, and so forth. So I'm just wondering, what is the process after the post-implementation review is done for us to, as a board, have an opportunity to consider what, if any, projects we should be taking on with respect to leasing?
Yeah, and first I'd like to note that we are also going to have Derek is going to attend the round table as well. So you have a rep there from the academic field. So as far as the feedback that we received, I know that there's work being done with respect to the PCC, and then we'll talk about some more of the feedback that we got today, like you had referred to regarding the cash flow statement, and one of the other disclosures. I think, what we'll do is we'll regroup on that. That won't be part of the PIR per se, but I know that the board is engaged in their agenda consultation right now. So I think that we would gather it all, and consider that along with the feedback that we get there, and then the team can decide what to bring back to the board.
Yeah.
outside of this though, so we can complete this.
Yeah, I mean, I think it'll be fair as part of the final readout of the report, just like RevRec, that there's going to be items that are highlighted in the final report. And if a majority of the board's interested in pursuing standard setting on some of those that aren't otherwise being addressed, either through agenda outreach or something, I think that's more than fair, just like any other topic, right?
Yeah, that, excuse me, that's what I was hoping to hear. I think that with RevRec, the timing was a little bit better in that we could identify some of those major areas, and they were, some of them were incorporated into the agenda consultation. So we were able to get explicit feedback on those. This one, the timing is a little bit different, but I think as long as it's brought back part and parcel with the rest of the agenda consultation, now would be the time to be thinking about whether there's need for work on leasing issues or not.
Okay. Other comments, questions? Lessee accounting in general? To me, what will certainly, and I'm looking forward to the roundtable, obviously, with the different stakeholder groups. So this may translate to all 6 of the questions. Is really leaving with a sense from each of our stakeholder groups. Are you better off with this standard than you were with the old standard, and why? Is it disclosure? Is it the accounting is better? Is it not? Were the costs, worth it? So, and I know we'll draw that out as part of the agenda outreach. And I know a lot of people have given us input on that as we've gone along, but I think that public discussion to me will be very helpful. Marcia?
A general observation I had, and I wasn't on the board through this standard, but I participated in organizations that were giving a lot of feedback during the standard. And I think there was a difference in what the expected costs were and what the final costs were. And I hope that in the roundtable, we start to learn a little bit more about why was there such a difference and what could have been done differently that would have given us a more realistic expectation of the actual costs earlier in the process.
Joyce?
Yeah, I think to follow on with what Marcia was saying, this standard, it highlights the importance that there may be potential costs to certain users. And those costs should be considered in the expected costs of the standard. In other words, in this case specifically, there were several non-public entity lenders that indicated they incurred costs as their banking institutions made system changes to their risk rating models that are used in their lender financial statement analysis. And quite notably, debt covenants were amended and loans were restructured. And those debt covenants that were modified were to exclude, in many cases, the effect of the right of use assets and the lease liabilities in their metric calculations. However, the creditworthiness of those clients and their willingness and ability to lend to those clients did not necessarily change as a result of the lease standard. So the standard highlights that as we consider potential costs, there potentially are costs to certain users who may not benefit as fully from the change in a given standard as other users. And they instead may incur costs to create new processes, in some cases to offset the impact of the standard.
Right. So I probably did a really bad job around question 1 and 2, but you heard our some of our feedback might have gone beyond that. But I also recognize that there's additional information that the staff has to share with both our audience and the board regarding some of the materials. So maybe let me turn it back to Jennifer now to give a little more in-depth
Yes.
overview of what we've done on lessee accounting.
Thank you. Yeah, so regarding lessee PIR activities, the staff proactively engage with stakeholders in both formal and informal settings to solicit feedback. A significant number of meetings were held with FASB advisory groups, regulators, public accounting firms, the AICPA's Technical Issues Committee, or the TIC, industry groups, and individual public and private preparer during the PIR. A public roundtable was held in September 2020 with investor, preparer, and practitioner stakeholders to discuss some of the fundamental areas of the lessee requirements. The feedback from that roundtable was then discussed at a December 2020 board meeting. In addition, the staff surveyed public entity and non-public entity financial statement preparers about their experiences with implementing and subsequently applying the Leases standard to collect additional data to assess the benefits and costs of the Leases standard. The staff actively monitored agenda requests and technical inquiries for pervasive implementation and ongoing implementation or application issues for the Leases standard. The staff also reviewed 33 academic studies about the effect of the Leases standard, all of which analyze the effects of financial reporting resulting from lessee accounting requirements under the Leases standard. Paragraphs 12 and 14 of the board meeting handout display the issues raised by stakeholders about lessee requirements of the Leases standard, which is separated by the number of times an issue was raised in stakeholder discussions and technical inquiries to which the staff responded. Paragraphs 13 and 15 of the board meeting handout include the number of individuals in stakeholder discussions by lessee stakeholder type and broad versus non-public entity specific. There were several primary areas raised by stakeholders related to lessee requirements in the Leases standard, and those are noted in paragraphs 17 through 27 of the handout. I'm going to touch on some more of the prominent issues raised throughout the PIR by lessee stakeholders, starting with general implementation issues, systems, and processes. Shortly after the issuance of the Leases standard, many preparer and practitioner stakeholders indicated that initially applying the lessee requirements as of the beginning of the earliest comparative period presented in the financial statements, including applying the disclosure requirements, was significantly more difficult than anticipated. This was primarily because their existing systems could not apply the requirements without significant upgrades, or newly developed software packages were not ready. Additionally, those stakeholders indicated that their ability to effectively adopt the Leases standard by its effective date were inhibited by resource constraints, such as limited accounting staff, which then required them to add personnel or use external consultants to understand and apply the requirements. Certain academic studies reviewed by the staff demonstrated that entities updated their systems and processes to comply with the Leases standard, and those studies observed that entities with leases were more likely to disclose investments or updates to their internal information systems during the transition period to the Leases standard as compared with entities without leases. Similarly, some of those entities disclosed a material change in their internal controls over financial reporting because of the changes in the accounting under the Leases standard. Moving on to transition. Along with commenting on the significant amount of transition requirements to affect recognizing all leases on the balance sheet as either operating or finance leases, including transition practical expedients, some stakeholders inquired about several areas of the transition requirements that they considered to be ambiguous. Moving on to discount rate. Discussions with preparer and practitioner stakeholders largely related to the challenges with determining an entity's incremental borrowing rate, or IBR, during implementation. Many preparer stakeholders indicated that determining IBR was difficult because, unlike its definition under legacy GAAP, the Leases standard requires that the rate reflect the rate of interest that a lessee would have to pay to borrow on a collateralized basis. Stakeholders also indicated that the IBR is more closely scrutinized under the Leases standard because all leases are required to be recognized on the lessee's balance sheet. Other stakeholder discussions on the lessee discount rate related to when a lessee should use the rate implicit in the lease and the application of the risk-free rate practical expedient afforded to non-public entities. Moving on to the next issue, identification of a lease, including embedded leases. Many stakeholders indicated that greater emphasis has been placed on identifying embedded leases as a result of the Leases standard because operating lease liabilities and assets are required to be recognized on a lessee's balance sheet. Stakeholders noted that there are significant costs and complexities associated with identifying embedded leases and questioned whether additional or amended guidance is needed to reduce the effort of identifying embedded leases. This issue continues to be raised by certain non-public entity stakeholders. Next, stakeholders provided feedback that the lease modification guidance under the leases standard can be complex and challenging to apply. Some stakeholders, they also acknowledge that the guidance is more straightforward and clearer than the lease modifications guidance under legacy GAAP. However, stakeholders observed that the lease modifications guidance under the leases standard requires that an entity evaluate multiple steps and in many cases update its accounting inputs and assumptions such as the discount rate and the fair value of the underlying asset, which can be costly or burdensome. Stakeholder discussions also included accounting for lease concessions related to the effects of the COVID-19 pandemic and modifications reducing the scope of a lease agreement. So for example, a master lease agreement. Although this issue is being discussed as part of the lessee feedback, it is also applicable to lessor accounting. Next, allocating between lease and non-lease components. Some stakeholders provided feedback that allocating the consideration in a contract between a lease component and a non-lease component using a relative standalone price basis, it's often difficult and may result in amounts allocated to the component that do not reflect the economics of the lease contract, particularly when the lease contract involves variable and fixed payments. This issue was raised by a number of times by non-public entity stakeholders, acknowledging that lessees are able to combine lease components and the associated non-lease components and account for them as a single lease component. Next, sale and leaseback. Stakeholders generally indicated that the sale and leaseback guidance under the leases standard is an improvement over legacy GAAP, particularly stating support for the changes to the requirements for determining whether a lessee controls the underlying asset while it is being constructed, so a built-to-suit transaction. Stakeholder discussions on this area largely comprised a couple of specific transaction types and questions about determining whether control has been transferred to the buyer lessor in certain situations in which a lessee has a repurchase option. Similar to modification accounting, the staff notes that this feedback is also applicable to lessor accounting. And related party leases. Almost all stakeholder discussions on the related party lease requirements related to observations from non-public entities that determining the legally enforceable terms and conditions of a common control arrangement for purposes of determining whether an arrangement is a lease, and if so, accounting for the lease is often difficult and costly to apply. So next I'm going to discuss the significant board and staff activities taken in response to the feedback that I just described. And those board activities and staff activities are included in paragraphs 28 through 34 of the board meeting handout. First, to address general implementation issues, the board added a transition method to allow all entities to apply Topic 842 at an entity's adoption date with a cumulative effect adjustment to opening balance of retained earnings. So no comparative periods were required to be presented in accordance with the leases standard. Additionally, the board deferred the effective date for non-public entities twice, once in late 2019 and again in 2020 because of the effects of COVID-19, making the guidance effective for those entities for fiscal years beginning after December 15th, 2021, and interim periods within fiscal years beginning after December 15th, 2022. Second, in response to feedback that the risk-free rate election available to non-public entity lessees in place of IBR being required at the entity level may limit the use of the election, the board amended the election in November of 2021 to permit it being applied by class of underlying asset. Third, based on feedback from non-public entities about applying the legally enforceable terms and conditions requirements to common control arrangements, the board amended the leases standard to provide non-public entities with the practical expedient to use the written terms and conditions for those arrangements to determine if a lease exists, and if so, the accounting for the lease. The board also amended the accounting for leasehold improvements requirements associated with common control arrangements, which is applicable to all entities. During the last half of 2020 through May of 2022, the board considered whether to amend the lease modification guidance. Specifically, the board proposed amendments for accounting for a contractual reduction in scope for arrangements such as master leases, and then had a project on its agenda to consider whether broader changes were warranted to the modification requirements for both lessees and lessors. At that time, stakeholders indicated as part of the 2021 agenda consultation and as part of outreach, the lease modification accounting should not be a board priority. Therefore, the board has not further considered whether changes to that guidance are warranted. The staff notes that other changes to the lessee requirements were considered and made in response to feedback that was less significant. And those other changes are included in your board meeting handout. So with that, we have one question for the board from the lessee perspective, and that is question 3 in the handout. Does the board have any questions or comments on the PIR activities completed on the lessee accounting requirements in the leases standard?
Thanks, Jennifer. Any questions or comments other than an observation? There's certainly an awful lot of post-implementation review activities since the issuance. Jennifer, I think it does highlight many of the topics that Christine was referring to, or the things we want to take a look at in the future. We'll obviously get some more input on those via the roundtable and other processes as we work forward to completing this. You mentioned transition, which, we had a discussion a little earlier today on transition and picking an approach, and some comments were made. Should we have a consistent transition approach? This is probably a good example of where I think we, as an organization, bent over backwards trying to make transition easier by giving lots of options. And one of the questions was, by giving all those options, did we actually make transition harder because people had to live with every one of those decisions for the entire life of the lease? Right? And did that complicate the systems that they needed because they weren't a single system, they needed multiple systems? So I think that would be interesting to pull that out from some of the preparers in the roundtable. Did with the benefit of hindsight, did they pick some options they wish they hadn't? And did that complicate things? So certainly an awful lot there for us to process through. I also think it'll be helpful. The PIR in some ways is second guessing the decisions made when the standard was issued, right? By saying, did the benefits and costs come about? Some of those items that are highlighted, it'll be interesting if people think we could have made a better decision when the standard was issued, but it's not worth changing again. Because I think we often hear that. In other words, I would have preferred when you issued the standard, you would have allowed me to do something different on embedded leases. But do I want to revisit that now that I've adopted the standard? Is the potential change worth the cost of revisiting that and coming up with a whole new definition? And what I find interesting is you might say that you would evaluate it differently at the time had we known everything we know now, but it still may not be worth changing today. And I think that'll help us as a board as we decide on looking at things. And I just picked embedded leases as an example, since sounds like the PCCs might be talking about that. Okay, Sue?
I just maybe comment on a couple of items in this section. I think one thing that was maybe unexpected to me as part of the feedback that we got was the amount of cost and effort that companies had to undertake to actually develop their inventory of leases. I think maybe I would have thought that the footnote would have formed the basis for some of that inventory, recognizing the need to identify embedded leases, much like you just said, Rich. And, what Jennifer had indicated, that it wasn't as important under 840, right? Even though the guidance didn't change, it wasn't as important under 842 or under 840 as it is under 842. So that kind of was a little bit of a surprise to me, maybe when, hearing about some of the amount of effort that was needed by companies to actually implement. The other thing that was a little bit of a surprise to me, and maybe it shouldn't have been, but I think, when the board at the time did outreach on whether companies would need to apply a new system or not, the thought process or the sentiment by the board at the time, and I think it was captured in the basis, was that no, there isn't really, you don't have to, and probably acknowledge that some companies would likely implement systems, but I'm not sure that that there was a sentiment that was thought about at the time that most companies would employ some type of system. And then, maybe the bigger question is whether the system solutions were actually ready. And, much like we've talked about other things, maybe that's a different discussion from a process perspective of how you employ, as we standard set these system solutions into the timeline and the effective date of what we ultimately decide. That's probably more of a process question, but I thought as part of some of the lessee outreach that you did, and by the way, just a ton of outreach. So thanks for doing that. Those were sort of two things that stood out to me.
Hillary?
I appreciate all of the feedback that we've received over time. Just a couple of things. When talking about all the different issues that have come up from a lessee perspective, certainly I think, and it is more process focused, and I know we'll come back to that, is whether or not a TRG would have been helpful here. Just thinking about it in comparison to some of the feedback that we received on the revenue recognition standard. That's something that just popped into my head, multiple times and kind of reading through the feedback that we got. Certainly, I know there was a reasoning of thinking about, well, the concepts in 842 are not dissimilar, right, from what was in 840. But I think it's a good thing for us to think about, even in those circumstances, when you have kind of these holistic changes, right, is that something that we need to be thinking about? And certainly Rich mentioned transition. I think that we gave a multitude of transition options, but we still had to give more, right, from a standard setting perspective to make sure that people could implement it in a cost-effective manner. So certainly very interested in the thoughts and perspectives of our stakeholders and how we can use that from a learnings perspective going forward.
Christine?
Yeah, I think Sue was talking about the inventory of leases and the amount of effort that was required in order to get a complete inventory of the leases and to consider embedded leases. I continue to be very perplexed by that feedback that we've heard over and over again, that was a large portion of the cost of implementing this standard, because FAS 13 was issued in 1976. It had been around for decades, and it required a complete inventory of leases, I think, for the disclosures to be fulsome. And clearly, investors were relying heavily on those disclosures to do their own adjustments to get the lease obligation and lease asset on balance sheet. So if they were dealing with incomplete disclosures, that's pretty concerning, I would say. And I'm particularly, I guess, bothered in some respects by the comments that the information, that it was held to almost a higher standard when it's going to be put into the financial statements through recognition and measurement as a leased asset and a lease liability. And yet somehow when it was just in the footnotes, it wasn't as important. I don't think investors really care where the information is sometimes. They're going to assume that it's of the same quality, whether it's in the footnotes or on the face of the statements. And we just hear that enough that I think that on a go-forward basis, the board needs to have a better understanding of whether there is a different materiality level or a different level of care that is applied when information is provided in the footnotes versus when it's recognized in the financial statements. I hope that's not the case, but we keep hearing that. So it's relative. I'm just curious about that. The other thing that I took away from some of the academic research that I think was additive to what we were hearing from stakeholders had to do with variable lease payments, and that statistically, variable lease payments look almost identical to fixed lease payments. That they are very sticky over time, that they can be predicted with a very high level of accuracy. And I think we also heard from investors that back when they were doing their rule of thumb adjustments based on the information that was in the footnote, so 8 times payments or whatever the calculation was that they were doing in order to try to constructively capitalize the operating leases, that they would include the variable lease payments in those calculations. So they were effectively capitalizing both the fixed and the variable lease payments, at least that's my understanding. And there's some concern expressed by some investors that the decision to exclude the variable lease payments from the capitalization has resulted in what they would view as an understatement of the amounts that are being reflected in the financial statements. So I think that from what we're hearing from investors, as well as what the academic research is indicating, that that might be another area that the board should be thinking about down the path as to whether or not we got that right. Thanks.
So just maybe jumping on to one of Christine's points, it looks like we've had now 2 major standards, stock comp and leasing, where we went in with the presumption that disclosure reduced the cost of adoption, and it didn't. And so to me, as I think of our role as a standard setter, right, we're not going to be the compliance people. I don't think the SEC is going to delegate setting materiality to us and how that's evaluated. But what is fully in our scope is, should we be making that assumption? And to me, it might be a fair point for future standard setting that we, with these large scale standards like stock comp and leasing, particularly if we change the definition of a lease, we shouldn't be making that assumption that that greatly reduces the cost. Maybe it will at some point in the future. Maybe there'll be some change in the way certain things are done. But as of now, I think we've got pretty good evidence that might be an error going in. And we should not presume that disclosure eases the cost of on-balance sheet accounting. Chris?
Yeah, and I'm just going back to the point on costs, right? And the expectation, right, that costs would be reduced, if the board retained the 2 classification. I think one of the things that we want to tease out next week as well is if those costs were being compared to the ED that was put out in 2013, or if they were being compared to if I were to take the amount that I have disclosed and put that on my books, could I do that? Is it complete, and so forth? So I just wonder if you were comparing it to, the type A and the type B, or if you were comparing it going all the way back to 2005 or 2006.
Yeah, and Chris, I think that's an excellent point. Anytime we go through a discussion paper and multiple exposure drafts, are we getting feedback as this is better than that prior thing you proposed? Or are we getting feedback, this is better than what we're doing today? And I do worry that sometimes we get the feedback that I really hated that, so this is a little better, so I'll tell you I'm okay with it, versus it's still not a good answer. And from all of our stakeholders, I think that those are fair questions. And that might cause us as a board to realize that multiple exposure drafts, particularly if we're putting out things that we don't think we'll ever get through, may change the type of feedback we get and may not be the best for us as standard setters. Christine?
Yeah, I just wanted to agree with what you had said, Rich, earlier about, in cost benefit, that calculus of if something is disclosed, it, necessarily should be assumed that it's going to reduce the cost of implementing recognition and measurement. But I also want to say that as a standard setter, I've always believed that disclosure is not a substitute for appropriate recognition and measurement at a conceptual level. But the feedback that we got both around this standard and around stock comp as well, that the numbers would be different if they were in the financial statements versus if they're just in the footnotes. Even more so makes me feel that disclosure is not an appropriate substitute for recognition and measurement in the financial statements, because it does appear to have a different standard applied if it's disclosed.
Okay. Anything else? Because I know you have more tee-ups coming. Ashley?
Yep.
And
All right, thanks, Rich. Moving on to lessor PIR activities. The staff is also engaged with stakeholders in both formal and informal settings to solicit feedback from a lessor perspective. Similar to the engagement with lessee stakeholders, discussions have been had with advisory groups, regulators, users, public accounting firms, the AICPA TIC, industry groups, and public and private company preparers. Paragraphs 38 and 40 of the board meeting handout outline the issues raised by stakeholders about the lessor requirements of the Leases standard, separated by the number of times that an issue was raised in stakeholder discussions and the number of technical inquiries to which the staff responded. Paragraphs 39 and 41 of the board meeting handout include the number of individuals in the stakeholder discussions separated by lessor stakeholder type. I'll start by providing a summary of the primary issues raised by lessor stakeholders throughout the PIR process, and these are described in paragraphs 43 through 46 of the handout. The first issue relates to allocating between lease and non-lease components. Most of the feedback on this topic related to a request from certain lessors to allow lessors to forego the separation of non-lease components from the associated lease component, consistent with the practical expedient afforded to lessees. Those stakeholders emphasized that separating non-lease components, such as common area maintenance, from the associated lease component was a change from legacy GAAP that would have little, if any, meaningful recognition and measurement effect. Those stakeholders also observed that any allocation method that they would use to separate the components would be judgmental, and that separating lease and non-lease components would not align with or accurately reflect the economics of those transactions. Next, I'll describe the primary issues raised on lessor recognition and measurement requirements. These include sales taxes and other similar taxes, certain lessor costs such as insurance and property taxes, and sales type or direct financing leases with variable payments. So some stakeholders requested clarification about whether the board intended for lessors to account for sales taxes and other similar taxes collected on behalf of third parties as lease revenue with an offsetting tax expense, or as a pass-through to the taxing authority, meaning no income statement recognition. These same stakeholders also requested clarification of whether certain lessor costs that the lessee pays directly to a third party, such as insurance in which the lessor is the beneficiary, should be accounted for as lessor costs. As it relates to sales type or direct financing leases with variable payments, most of the feedback on this topic related to an agenda request in which a utility trade group requested that the board address a narrow but pervasive issue on lessors accounting for sales type leases with significant variable lease payments. They observed that under the Leases standard, a loss would be recognized at lease commencement for these leases because a lessor is not permitted to estimate most variable payments when determining the lease receivable portion of its net investment in the lease. Consequently, the net investment in the lease for a sales type lease or a direct financing lease with significant variable payments may be less than the carrying amount of the underlying asset derecognized at lease commencement, resulting in the recognition of a day one loss, even if the lessor expected that the arrangement would be profitable overall. Stakeholders highlighted that this accounting was a change from legacy GAAP. Stakeholders also highlighted certain differences between the requirements in Topic 606 and the Leases standard that affect how amounts are recognized. Some of these differences included One, the collectability threshold for recognizing revenue under topic 606 for contract consideration is different from the collectability threshold applies to sales type leases. Two, the existence of a repurchase option generally precludes an entity from recognizing revenue under topic 606 and under the derecognition guidance in subtopic 61020. However, a selling profit may be recognized under the leases standard for a sales type lease with a repurchase option. Third, variable consideration is estimated under topic 606, but variable lease payments are not estimated for purposes of applying the leases standard. And four, under topic 606, a seller does not reassess the collectability of the consideration in the contract unless a customer's ability to pay the consideration deteriorates significantly. For operating leases under the leases standard, a lessor determines at lease commencement and on an ongoing basis whether collectability of the lease payments is not probable. Next, I'll cover board and staff actions taken in response to some of the lessor issues raised, which are summarized in paragraphs 47 through 56 of the handout. In response to stakeholder feedback on the allocation between lease and non-lease components, in July 2018, the board amended the leases standard to permit lessors to combine lease and non-lease components and account for them as a single component if certain conditions were met. The board also specified that if the non-lease component or components are the predominant component, an entity should account for the combined component in accordance with topic 606. Otherwise, the entity should account for the combined component as an operating lease in accordance with topic 842. To address the feedback received on sales taxes and other similar taxes, in December 2018, the board amended the leases standard to permit lessors to forego their evaluations of whether such taxes are lessee or lessor costs. An entity that makes this accounting policy election should not account for those costs as lessor costs, resulting in no income statement recognition. Also in December 2018, the board addressed the feedback received on certain lessor costs, such as insurance and property taxes, by amending the leases standard to require that lessors exclude such lessor costs from variable payments and therefore from lease revenue. The board also specified that costs excluded from the consideration of a contract that are paid by the lessor and reimbursed by the lessee should be accounted for as variable payments and therefore included in revenue. In March 2019, the board reinstated the requirement that existed in Legacy GAAP for manufacturer or dealer lessors to use the cost of the underlying asset as its fair value at commencement date instead of using the master glossary definition of fair value. Next, in July 2021, the board addressed the concerns raised that a lessor may recognize a selling loss at lease commencement for sales type leases with significant variable payments. The board amended the leases standard to specify that lessors should classify and account for a lease with variable lease payments that do not depend on a reference index or a rate as an operating lease if both of the following criteria are met. One, the lease would have been classified as a sales type lease or a direct financing lease. And two, the lessor would have otherwise recognized a day one loss. And lastly, at the July 17th, 2019 board meeting, the board discussed concerns raised related to a lessor's accounting for impairment of operating lease receivables after the initial application of the leases standard. At that meeting, the staff communicated methods that it considered acceptable for the impairment of operating lease receivables with a goal of minimizing disruption in practice. The staff notes that other changes to the lessor accounting requirements were considered and made in response to feedback that was less significant. Those other changes are included in the board meeting handout. And with that, I will hand it back over to the board to discuss question 4 in the board meeting handout, which asks, does the board have any questions or comments on the PAR activities completed on the lessor accounting requirements of the leases standard?
So hard to believe some said we didn't make substantial changes to lessor accounting, Ashley. But, and I say that as a joke, but not really, because I do wonder if one of the challenges we had here was, well, we didn't make all the changes to lessor accounting that were in some of the EDs, which were pretty radical. We did make changes, and sometimes they were because of the lease standard, but sometimes they were due to the fact that we had a RevRec standard that got rid of special accounting for real estate. So we got rid of the special accounting for leases of real estate. At the same point in time, we issued a standard on collectability of receivables, and we couldn't quite decide whether we thought lease receivables were the receivables that we were assessing collectability of, and so could you do something else? So Interestingly enough, I do wonder if we reduced attention on this issue. And I'll be interested to hear, and I know we don't have as many lessors giving us a lot of input on PIR, but interesting if we may have inadvertently minimized the lessor effect of those cumulative standards. And as a result, we heard more and more from them as time went on. Chris?
Yeah, and I think it's a good point. I think one of the things as we went through this and we looked back at what occurred from, call it between 2016 and the start of 2019 to the point about the TRG. I at least, having been a part of that, thought back and said, well, would a TRG have helped with this as well? With the lessor guidance. I mean, the fact that we had one for 606, we tried to align it in part to 606, yet there was a lot of talk. I mean, I know Sue was there that we had with regards to lessor account counting and trying to get back to the financial reporting that had occurred in accordance with prior GAAP.
Yeah. And I think one thing that may be helpful for me to hear from some of our roundtable participants is, in the absence of a TRG, some of these issues were raised to the board and resolved there. But there were a ton of other implementation issues that got resolved somewhere. And providing some transparency into how those then got resolved and what's the trade-off between them being resolved via those mechanisms versus being resolved in public via TRG that we sponsor might be helpful, particularly as we think of establishing TRGs in the future. All right. Anything else for Ashley, lessor? I know this sounds like a lot, but one thing, it certainly illustrates a lot of the work that our staff and our stakeholders put in. So with that, let me turn it over to Lauren to bring us home with investors. Lauren?
Thank you. So paragraph 57 and onwards in the handout includes a discussion of the benefits of the leases standard as viewed from the perspective of investors and the academic literature review. Throughout the PIR, the board and the staff has undertaken 2 investor outreach programs. We've met with investors as part of the FASB's advisory meetings on multiple occasions, including IAC, and as part of the 2020 roundtable. In addition, we've undertaken a significant amount of non-public investor outreach, including lenders, sureties, and private equity investors. The basis for conclusion states that the board developed Topic 842 principally to improve users' understanding about lessees' obligations under lease contracts. The board concluded that the standard provided transparent and neutral information about the assets and the liabilities that arise from leases, which was in contrast to the incomplete information provided about leases in previous GAAP that did not recognize assets and liabilities that arise from most leases. At issuance, the board acknowledged that users' leasing informational needs may vary depending on the type of user that they are. For example, credit analysts or equity analysts, and the industry in which the entity operates. The board further acknowledged that some users would continue to adjust the reported right-of-use assets and lease liabilities in their analysis. So as part of the information that we collected for the PIR, investor feedback on the reported lease information was based on whether and how they use the lease liability, right-of-use asset, income statement, disclosures, and any other observations. Almost all investors providing feedback commented that the disclosures are an improvement from legacy GAAP and noted that the lease disclosures such as the weighted average lease term and the discount rate are key benefits of the standard. The disclosures improve the information available to investors to more precisely analyze the effect of leases and therefore reduced the need for users to make assumptions in their analysis. Many public entity investors indicated that they use reported lease liabilities in their analysis of an entity's financial position with minimal or no adjustments, while others use the reported lease liability along with other factors or adjustments to estimate the lease liability. In contrast, many investors indicated they do not consider the reported lease liability in their analysis and estimate it using methods such as a multiple of rent expense, such as 6 to 8 times the expense. Non-public investors provided mixed views on whether and how they use the reported lease liability, which is generally consistent with the feedback received from public entity investors. Regarding the right of use asset, several investors indicated that they include the reported ROU asset in their models and they evaluate metrics such as return on assets or the return on investment. However, many other investors stated they have minimal, if any, consideration of the right of use assets in their analysis, citing a lack of context for what that amount represents. With respect to the income statement effects of the standard, many investors stated a preference for the leases standard expense recognition approach of a single lease cost for operating leases, as opposed to interest and amortization that would result from finance lease accounting. Those investors indicated that they consider operating leases to represent an operating activity and not a financing activity, and thus support the separate income statement reporting for operating leases and finance leases. Some credit analysts stated that they view all lease activities as finance activities, and therefore they convert the single lease expense reported under the standard for operating leases into separate interest expense and amortization expense amounts. Investors also provided a couple of other observations. First, many investors stated diversity in the presentation of operating lease activities in the statement of cash flow. Specifically, some entities present the change in the operating lease ROU asset as a non-cash adjustment to net income, and separately present the change in lease liability as a change in working capital. Other entities present the change in both the ROU asset and the lease liability as a change in working capital. The second observation that investors had is that several stated a preference for more robust disclosures about the nature of the underlying assets that are being leased, such as delivery trucks, office or retail space, and the economic lives of those assets to better analyze an entity's leasing activities. And finally, the staff looked at academic studies that generally indicated that consistent with the board's expectation at issuance, the leases standard provides a more faithful representation of the rights and the obligations arising from lease transactions that improves comparability that end users' understanding of an entity's financial commitments. In general, the academic studies provided the following insights. Number one, the reported operating lease liabilities and assets under the leases standard reflects lessee's obligations and rights more precisely than the amounts that were disclosed under legacy GAAP. Number two, changes in accounting and additional information that lessees disclose under the leases standard had a significant effect on equity, credit, and lending markets, as evidenced by the changes in investors' decisions. And third, little evidence exists that suggests that the leases standard resulted in a significant and negative economic consequences that some stakeholders had predicted. And so with that, I'll turn it back to the board to ask questions 5 and 6. And question 5 begins with, does the board have any questions or comments on the PR activities performed with investors? And question 6 is, does the board have any questions or comments on the PIR feedback from investors?
Great. Thanks, Lauren. And I think it was very helpful to split out the investor feedback by type of investor, particularly credit analysts versus equity. Any questions or comments, Fred?
One question and a comment. We just heard about the significant changes in lessor accounting. However, I was curious of any outreach that we did with analysts who follow lessors, because I think the presumption was, while there was a lot of changes to lessor accounting, the impact on the actual financial statements was fairly modest. Is that?
Yeah, we did some outreach with less companies analysts that follow leasing companies. And from their perspective, they literally weren't even aware that we had made changes. So, when we talked to them about some of the changes they made, they said that they weren't that meaningful for them.
Yeah, and Fred, I'd know as well that upon what the board did between 2016 and 2019, it brought back the lessor financial reporting outcomes to what it was in prior GAAP, for what we had explained. So there really, in our view, was not that large of a change where they would note that.
Thanks. Oh, did you want to follow the lessor? Oh, I had a comment. Oh, just a comment on, I think when we talk about accounting outcomes and we view diversity as a bad thing, that we don't like diversity. But I think it's important in my mind when we talk about financial analysis that diversity of financial analysis isn't a bad thing. In fact, that's what makes the capital markets go and employs a lot of people. Everybody's trying to get an edge and trying to use the information in a unique and novel way. So I just think it's important to recognize that the fact that even different credit analysts look at these differently, equity analysts look at differently, industry looks at things differently, and the fact that within two sell-side analysts looking at the same industry are going to look at it differently. That's simply the way that capital markets work, and I think that outcome, in my mind, shouldn't be viewed negatively.
I didn't view it poorly. I just thought it was helpful to have an insight into what information people are using and maybe using for different purposes. And it was an optionality, right? So, Christine?
Yeah, the investor analysis is always challenging, right? Because it's hard to identify folks to talk to. In particular, this standard was much more impactful in certain industries than it was in other industries, which further reduces the pool. And then, of course, you've got all of the different flavors of investors as well, using the information differently from one another. And I think from my perspective as a board member, when, we talk to 40 investors and that's helpful, but once you salami slice it all the different ways that it has to be sliced, we're ultimately talking about very small samples. And I find it hard to draw broad conclusions from such small samples of investors, in particularly when we compare it to a much larger sample of preparers and auditors that we were able to talk to. So while we had 40 investors in the individual contacts that we did, we had over 380 such contacts with auditors and over 150 with preparers. So we're talking over well over 500 individual contacts on the cost side, but only 40 on the benefit side. And I think that that's not something that's easily overcome. It's just the way it is in terms of how we can do outreach. But I do think that it results in us needing to emphasize much more the results of the academic research, where they are looking at large samples and broad impacts on the capital markets. And Lauren, you said this, and I'll just reiterate that what the results of those studies indicate is that the leasing standard did result in more faithful representation of rights and obligations in the financial statements themselves, and that the standard did produce new information that is being used by market participants. And I think we can take a lot of comfort from that evidence. The other thing I would like to just encourage the staff to think about doing, and I know it's probably too late for this standard, but maybe in future post-implementation review, and that is that we did 2 preparer surveys on cost. We didn't do any surveys of investors on the benefits. And I think there are databases that would have allowed us to identify analysts that follow, in particular, the types of industries that were largely affected because they have so many leases: transportation, restaurants, I think hotels, apparel. There's a list that we're aware of, and I think it would have been at least helpful for me to have seen the results of a survey of investors. I know that we might not have gotten a lot of response to that, but we don't know if we don't try. Yeah.
Okay, thanks. Shandy?
Thanks. I just wanted to explain a little bit about the way we go about trying to bring the investor perspective to standard setting. I mean, one of the ways is identifying those industries that are most affected and then going out and looking at users of financial statements in those industries. So if we think about something like retail and airlines and hotels, things of that nature, we talk to a smattering of analysts and investors in those industries, and we do it to get, and we also review sell-side reports and things of that nature to make sure that we understand generally how the information is being used by folks in that industry. So when we say something like, the asset number isn't really being used, think about those industries: retail, airlines, hotels. Those analysts, because they're so close to the individual companies and their information, they're going to be using such a wide set of information that includes things like restaurant level economics, square footage returns, those store level economics, hotel level economics. Airline analysts are going to have the entire fleet and understand by type of plane, the usage of the plane, the returns on that type of plane. So when we talk about financial statements and a number for assets, yeah, they're not going to use that, because the closer they get to that level of understanding about a company, this is not going to be where they get that type of analysis performed. So then we look at the liability side and we say, okay, the liability side, for most ongoing companies, analysts aren't going to view it as any different as just another operating cost. And whether you call it debt or you call it a liability, they're just going to be concerned, can they make their payments, and what is the expense structure of this company overall. So from that perspective as well, for them, whether you have a lease term of 5 years or 15 years, yeah, it tells them something. And they appreciate the fact that, we've given them the average lease term, because now they understand, okay, having a 5-year lease term could be different from having a 15-year, but it may not be, because they can renegotiate, but at least it gives them some level of understanding. But in terms of the measurement of the liability, I don't think that they're going to rely solely on that. Now, where this gets a little different is the further you go away from individual company analysis to a full industry, where you're maybe running screens to say, okay, is my ROA higher than my weighted average of capital? That's where you start to say, okay, I need to have some knowledge that this ROA is affected by how you're accounting for the assets. And is my liability being affected by lease term and things like that? So what I would say is, directionally, what we heard is these directionally, the changes we made to lease accounting became more accurate because certain things were off and now they're on balance sheet. But, you know, analysts for the most part aren't so caught up in, well, is it variable? Was there a shift to more financing? Those types of things. Because the closer they get to that company, they're going to understand those differences when they see a retailer that is, you know, a drug retailer that has 5-year term versus a 15-year term. They're going to know exactly what that means, you know, and where it's meaningful, where it isn't that meaningful. So I'm not sure increasing the sample size would necessarily do that much for us. So, you know, all I can say is that our objective is to feel like we've talked to enough people to give us a sense of how the information is and isn't being used. So,
Okay.
Sorry for that long.
All right. Thanks, Shandy. And obviously the elephant in the room is we also have a report from the SEC that was in response to an act of Congress identifying leases as the largest item of off balance sheet, which I don't think we should forget. And you know, that let's say that unprecedented type of feedback to us in our role as standard setters is certainly something unique. Okay. With that, team, wanted to thank you very much. Any additional questions for Lauren? Oh, go ahead, Joyce.
Well, I'll just make a comment that I think that the standard highlights for investors the use of judgment, estimates, and assumptions. And as we know, judgment, of course, is an inherent aspect of accounting. But there are some investors that stated that they do not use the operating lease liability in their analysis because the measurement of the lease liability requires significant management judgment in determining the discount rate. And academic research has indicated that companies appear to strategically use their discretion in selecting discount rates to minimize the liabilities that they report on the balance sheet. And in that research, those companies tend to be ones that are highly levered or have lower profitability, or their financial statements are more opaque. So I think investors are expressing some concern about that use. They've also noted that there's significant management judgment in lease terms, and notably where the preparer is determining renewal periods as it relates to those leases. And that, of course, could result in potentially significantly different liabilities being recognized on the balance sheet. So I think it's important, particularly what Shandy has mentioned, is that they recognize that there's this judgment. They recognize that there are these estimates and assumptions, and they have other means to sort of check from some confirmatory approach to ensure that what they're using versus what the company may have is logical for their analysis. But I think it's important that we monitor the sufficiency of financial statement information pertaining to the use of judgment and estimates and assumptions, because it is relevant to investors. Again, while they may not be using it entirely, they are using it as a benchmark to work through their analysis.
Okay, great. Not seeing any other hands. Certainly gave us as board members a chance to let you hear lots of different things today. And next Friday, the 12th at 10 Eastern time, we as board members will get a chance to listen to a lot of input from stakeholders at our roundtable. So looking forward to that, and looking forward to our team and our stakeholders joining us next Friday. So with that, I'd like to conclude today's meeting. Thanks, everyone.